Thanks, everyone, for attending, I think, our third or fourth panel on monetary policy, at least that I participated in here at the Milken Institute. I'm not going to go through detailed bios, but needless to say, you have 4 ex-Federal Reserve employees sitting here, along with Cliff Noreen, the sort of one-man out, who is an asset manager at Babson Capital and has been managing credit portfolios for a very, very long time, and we're excited to have him on the panel again as well. But you can look for the bios in the back. But needless to say, you have a lot of Fed experience up here, and we're going to spend an enormous amount of time talking about the Fed, but also try to bring in some of the issues related to the other central banks out there. I'm going to start with one of the issues that I think most of our clients at Jefferies, as well as most folks out there looking at monetary policy, are probably most interested in, and that is Fed communications. We have a new chair at the Fed. The communications, at least in some people's opinion, including my own, have been less than stellar. And I wanted to open it up to Brian Sack, who has spent a lot of time inside the institution, and ask him his opinion on how you think Fed communications, Brian, have been going so far under our new chair.
Okay, well, thanks. I think the big picture here is that we should all expect the Yellen Fed over time to communicate very well. Janet Yellen has always emphasized the importance of central bank transparency, not just for accountability, but for the effective transmission of monetary policy. She believes providing the public and the markets with information about what's driving policy decisions is very helpful. It lets the markets anticipate policy. It's stabilizing. She has experience with central bank communication issues. She was appointed the head of a subcommittee on communications by then Chairman Bernanke in 2010. And they did a number of important things, including putting out a policy strategy statement by the FOMC that actually defined the inflation objective of 2%. And she has a history of providing a lot of very rich information about her own policy views in her speeches. So clearly she believes in providing a lot of information and being very transparent. Now, as Dave suggested, that does not mean it's been very smooth so far. And you can see that in Dave's own commentaries. Dave obviously writes about markets and the Fed and has a very wide readership. And I would say Dave's relationship with Chairman Yellen so far has been pretty volatile after her press conference. I think he put out a piece giving her a C-. And then he's sung the praises of all of her recent speeches. So I think what happened is we had a press conference, Chairman Yellen's first press conference, and it was surprisingly hawkish to people for a couple of reasons, but one of them was that she explicitly defined a considerable period of time, which is what the FOMC statement said, that the funds rate would remain on hold for after asset purchases end. Well, she defined that as about 6 months. She probably would rather have a do-over on that and maybe not be so precise, but it was a hawkish reaction. And then followed by these more dovish speeches, and I think this back and forth has frustrated some about communications. But I did just want to point out, I think the current circumstances are actually very challenging for central bank communications, right? I mean, the Fed is approaching the end of its asset purchase program, is tapering that. It's an unprecedented program. It's put the balance sheet up towards $4.5 trillion. So that's complicated enough. But even more importantly, the prospect of adjustments to short-term interest rates are really on the horizon now, and the Fed has to be communicating more about that. And this is following a period of time of what will be 6 or 7 years where short-term interest rates have been completely inactive, pinned up against the zero bound. So I think the circumstances are challenging, and it would be hard for any central bank to be communicating, especially one with a new chair. Just say a few more things about communications. I think if we step back and look at communications and the guidance about short-term interest rates the Fed has offered, I think it's actually been quite successful. So remember, the Fed in 2011 began to provide guidance about the federal funds rate, first with calendar dates, and then later with economic thresholds, and then most recently with more qualitative guidance about policy prospects. And I think all of that has done a good job at anchoring the front end of the yield curve, and that's helped to support growth in the United States and move the economy towards the Fed's objectives. So I think it's been a good experience with guidance, and they've actually managed transitions between those different phases pretty effectively. So today it's very clear what their message is. The FOMC is going to be patient with regards to the liftoff of the federal funds rate. As I mentioned, the statement says there will be a considerable time between the end of asset purchases and the beginning of rate hikes. The FOMC is communicating that the tightening cycle when it approaches is going to be gradual. The statement emphasized that rates would be low even as unemployment and inflation move back towards the mandates. But third, and also very important, and this was very clear in the chairman's last speech, Chair Yellen's last speech, is that policy has to be responsive to the outlook. So that's what the FOMC anticipates is going to happen under their baseline forecast. But as that outlook shifts, then monetary policy prospects are going to have to shift as well. So they're kind of walking the markets gingerly back to a world where the markets will have to contend with active short rate adjustments, but they're getting there, as I said, gingerly.
So before I open it up to a few others to have a brief comment on what you said, Brian, one thing that I think also jolted the markets a little bit after that press conference was this statement about the dots being not particularly meaningful. And we spent an enormous amount of time watching these rate projections out in 2015, 16 that the Federal Reserve puts out, and they all went up fairly dramatically, or certainly more than people's expectations in the later edges of the forecast. And to hear the chair tell us that maybe the dots aren't that important and we shouldn't pay attention to them, even when that's been the main forward guidance tool for us to be thinking about liftoff, seemed a little bit of sleight of hand to me. Did you have that same opinion?
To some degree. So right now, there's really two forms of communication about policy prospects. One is the FOMC statement. What Chair Yellen said is that's the primary vehicle for communicating about policy. And that's clearly right. The FOMC works on the statement together. They actually vote to agree on the statement. So that is a committee device for communicating about policy. And then you also have the forecast of individual FOMC members, including macro variables, but also including the federal funds rate expected at the end of the next 3 years. Those are not a committee communication device because it's just individual members' views, but it is an important communications device. And see, I think they both serve important purposes. I mean, I actually think the dots, which is what we're referring to the Fed funds forecasts of FOMC members when we talk about the dots because they're presented in a dot chart. I think the dots are very powerful, and in some ways more powerful than the statement because they're precise and they're quantitative. So the statement now is qualitative. That leaves a lot of room for judgment and a lot of different room for different paths of policy. But the forecasts are precise, and that is very valuable, very powerful. So I agree, it's a bit of a mistake. I don't think the Fed should be saying, ignore the dots, they're not important. I think the Fed should be realizing the dots are going, the markets are never going to ignore the dots. They're going to be an important communication device, and the Fed should be working on ways to improve the dots and make them more informative about future committee decisions.
Couldn't agree with that more. Anybody want to take up a quick?
Can I just add on this
before we move to another
conflict
topic?
between the dots
Yeah.
and the statement? I think this is really a problem that Yellen inherited. And if you go back to the April 2012 meeting, you had forecasts that were clearly at odds with the then calendar-based guidance.
Yeah.
And if you recall the press conference after that, Bernanke had to kind of hem and haw about these being inputs into the process and the statement being an output of the process. And so I do think there's a conflict there that, Yellen, as I said, inherited. And I see it kind of as a conflict between collegiality, which is what you see in the statement, and transparency, which for the Fed means, at least recently, being transparent about where all the different views are. So I think that conflict is, can't really blame on Yellen. That's part of the structure she took over.
But does she have an obligation to potentially at least explain the conflict to us a little bit?
Well, she gave the same, I think, explanation that Bernanke did about this being an input into the process, reflecting the variety of views. But as Brian was just saying, the statement, the final trumps it all, exactly.
I mean, I think the ultimate device would be for the committee to agree to a precise forecast and publish its forecast in a precise quantitative form. If you've ever sat through an FOMC meeting, you would know that's very unlikely to happen. It's hard to get 19 members to agree to a specific forecast. But there are second best options, and I think one of them is just labeling the dots. And not just the dots, the entire set of forecasts provided by the FOMC members. I mean, then as market participants, we could weight them as we want and kind of interpret them how we want. And I think...
discount the fringe?
Well, I mean, discount however you want. But I think, if FOMC members are going to publish a forecast and it's going to show up as a dot, I don't see why they shouldn't be accountable for putting their name on that forecast.
But can I jump in?
Yeah, please.
Brian, you don't think the market then would just gravitate toward Yellen's dot such that the outcome of the meeting is kind of predetermined?
So to some degree, but I mean, the market should, end up weighting the dots as it sees appropriate. So I don't think the market would inappropriately weigh one dot over another. It would assign appropriate weights. And you're not telling the markets how to weight the dots or interpret the dots. You're just giving the markets more information to do so.
Do you think that this is something that's forthcoming, that we'll see a labeling of the dots in the next 2 or 3 years?
So I think you may see something in this direction. So for example, President Lockhart recently talked about separating voting members of the FOMC's dots from non-voting members. So you may see a partial step, something like that. Or maybe you will see them go all the way. Another thing is, FOMC members can reveal their own forecasts and speeches, and so if we hear more and more of that, and more of them have been talking about various parts of their forecasts, so individually they may begin to reveal their forecasts, even if it's not a committee-wide decision.
I can step in here on a couple of points on communication. First of all, it's as you explained, Brian, it's been a sea change in increased transparency, but we need to realize that a big part of that is because the Fed funds rate is stuck at 0. So there is no other equivalent tool to the Fed funds rate before the crisis that can communicate the slight variations in monetary policy. The size of the balance sheet, for example, isn't as accurate a measure of that. And this is why the Fed has had to go in the direction of greatest transparency in communication. But we need to be careful with this, and my assessment is that at the Fed they also realize that you can overdo it. And in my mind, and reading 2 former Fed people trading on the other side now, talking about the importance of the dots are a perfect example of the Fed having gone overboard. Any central bank should be very careful with its communications and should be very careful not to mislead by communicating things that are highly uncertain, even to the central bank. This is why it's okay to announce an inflation forecast, which was, in my mind, the most significant change in Fed's communication over the past few years, have a target and extend the horizon forecast on that. But it's not a good idea to try to make precise statements about something like the Fed funds rate that each committee member is incredibly uncertain about. I would consider it very scary to identify names with the dots that would focus market participants' minds even more on something that no committee member can be particularly confident about, since they're going to have to change the stance of monetary policy as the outlook evolves. So we're talking about second best. My second best is to just get rid of these dots as quickly as possible. And I hope that when the Fed starts having to raise the Fed funds rate when they will no longer be stuck at the 0 bound, that would be a good occasion to move away from it.
So Athanasios, you're advocating sort of a move back to the Greenspan-esque Fed where the market is left confused at every turn. I think Alan used to have two things in his office.
Not at all, because communication has improved in ways that I believe are very useful. What is important for a good functioning framework is for the Fed to be predictable in what it's doing. So as long as they are explaining to us, and they are doing that, a very good job of that, explaining to us what the outlook for inflation is, what the outlook for real economic activity is, they're giving us a lot of information, even on things like the natural rate of unemployment that they don't really know much about. As long as they do that, they don't need to be giving us point estimates of where the Fed funds rate is going to be 2 years later. That if they're going to do that, I would much rather that they gave me probability distribution to explain to everybody in a frequency distribution, for example, how clueless they are.
I just completely so just very briefly, I mean, why shouldn't the Fed be able to explain what its own projection is of the economy? It's not a commitment. It's not tying their hands. Giving macro forecasts without the policy assumption is much less meaningful because you can't see what's driving the forecast. So I don't see much cost or much problem to the central banks providing forecasts and information about where they see things heading.
So we spent a lot of time on my first question, and we have a whole panel here, and I've tried to get some people going. Obviously, I think this is going to be a great panel already in the first 15 minutes. But I want to turn to another question, and I want to turn to Mike on this question because he's done a lot of work on it. The FOMC has spent a lot of time telling us that there's an enormous amount of slack in the economy. We hear numbers of millions and millions of people outside the labor force that could potentially come back in. We've had Larry Summers bring up the concept of secular stagnation. We see in the Fed's SEP forecast that risk-free real rate expectations are very low going out for the next 2 years plus, based on this idea that we can grow the economy quite quickly by bringing in a lot of this slack that was created during the crisis. And I want to, get you talking to people about how you see that secular stagnation debate, how you see that slack debate, maybe the difference between the short-term and the long-term unemployment rate that you've looked at pretty closely, and where are the pitfalls in all this? Is Janet and the committee, are they being too cavalier in thinking that they can bring all of these people back into the labor market with monetary policy, or is there a real inflation risk right around the corner?
Right. So, I think first, at the simplest level, the official unemployment rate, I think their forecast for that over the next few years looks pretty reasonable, right? They have unemployment falling by a little less than 0.5% per year over the next 2.5 years, which would be a slower pace of decline than we've seen in recent years, even with a faster outlook for growth. So that looks reasonable. Now the question is that a comprehensive measure of slack? And I think up until, perhaps 6 to 12 months ago, the view was pretty unanimous that the unemployment rate understated the degree of slack. And that principal reason, at least as pushed forward by the Doves, had been this participation rate gap. In other words, that the participation rate had fallen for cyclical reasons and it's going to come back. I actually see less and less adherence to that view, even among the Doves on the committee. I think there's been a growing body of research coming out of the Federal Reserve System suggesting that a lot of this decline in the participation rate was either structural, or even if it's cyclical, it's not going to turn around. And I think it was telling that Charlie Evans, who is an Uber Dove on the committee, recently said that even he concedes that about 3/4 of the decline in the participation rate is structural. However, it's been turning, I think, recently now toward part-time for economic reasons as a big measure of slack that's not captured in the unemployment rate. The handful of speeches Chair Yellen has given as a chair have all referenced part-time for economic reasons. So this seems to be where, the Doves are kind of focusing their rhetoric. However, I think there's been a little more balance into the debate, which suggests that perhaps there are some reasons to think that there is less slack than is measured by the official unemployment rate. One of the reasons, as you alluded to, is that the short-term unemployment rate is actually back toward its historical average or to its NAIRU, and the thinking there being that people who are unemployed longer than 6 months may have less influence on the marginal wage setting decision. So for thinking about inflationary purposes, maybe we don't have as much slack as we think. And this has been John Williams, who's Yellen's former research director, has expressed some sympathy for this view, as has the New York Fed staff. And then I think if you look at some other similar measures, like the insured unemployment rate, which comes out in the weekly jobless claims number, that's down to 2%. At the bottom of the last cycle, it was 1.8%. So I think there are some reasons to think that, there are smart people on both sides of this debate, but what's interesting is that now you have smart people on two sides, whereas it used to be really one-sided debate. So I think that does add perhaps some, upside inflation risk to the Fed's forecast. I don't think and I'm sympathetic to that view. That said, I don't think they're making a big policy mistake here, because I do believe that, the cost of signaling that they're going to go sooner rather than later are greater than the cost of signaling that they're going to go later rather than sooner.
So I know, Athanasios, you've had a lot of thoughts as well on the debate that's around the Fed on slack, and in particular the discussion of risk-free real rates being negative for a very, very long time at the short end for secular stagnation reasons, and I think partially also because of this excess slack story that is becoming less prevalent on the committee. How do you see this evolving in the next 2 years at the FOMC? Is the debate going to be to take that risk-free real rate expectation higher, to sort of take that slack out of the forecast and potentially give us a more hawkish Fed, or is this just going to continue a la the forecast where we see a Fed very much operating with a view like they did in the 70s, that the output gap is there? I don't care if inflation goes up because I still think there's an output gap that's there, and damn the torpedoes, we're gonna get people jobs.
Yeah, so tell you the truth, I'm a little bit more confident since the committee reversed the mistake they had done in the statement with the introduction of the thresholds on the unemployment rate in particular, that they will do the right thing and now contain incipient inflation when it does appear, as they have done so nicely in trying to ensure that there would not be deflation in the U.S. economy. But this whole debate about what is the equilibrium rate of unemployment, now we move to what is the equilibrium labor participation rate? Then we have what is the equilibrium real natural rate of interest? Since all of these are variables that in our models in economics we put stars on them. And frankly, we need to worry about any central bank operating with stars, because that may actually take us into the realm of astrology rather than science. And it can be a very, very dangerous thing. So the Fed has made this mistake in the past, and it's while all of us were at the Fed, this was before the crisis, the Fed was very well aware of the two earlier big mistakes in its history. One was the Great Depression, when the Fed had to worry about not letting the economy collapse. And I think that in this episode, the last 5 years, this is one of the legacies of Ben Bernanke's chairmanship, is that he avoided a repeat of the Great Depression, even though the initial shock, in my view, was worse than the shock of the U.S. economy in 1929, 1930. But then there is the other mistake, trying to fine-tune the economy to such an extent that by trying to chase these stars, the full employment rate of unemployment and labor participation and so forth, has the Fed take its eye off maintaining price stability. And this, in my mind, is a real concern. We know what the size of the balance sheet is right now. We know that this balance sheet will have to be normalized if the Fed is going to take back control of monetary policy once they get out of the zero bound. So if there is overemphasis on trying to hit full employment targets, I think we have a very significant one-sided risk. Now, the real interest rate issue. I worry that this is very much linked to the optimal control exercises that we've seen in a number of Fed speeches and Fed papers in the last 3-4 years. And there is a very, very serious flaw in any optimal control exercises of the sort that we see in these speeches. They assume that we know what the world is like. And of course, things are very different if we can all assume, this astrology thing with R star, equilibrium real interest rate is negative. It has been negative for a while. It's very different if I start designing my dots for the next several years, starting with a negative real interest rate, what we know historically is that the uncertainty about these concepts is so great that they may be off by a couple hundred basis points on that concept. And you can imagine what implications this may have if they are wrong a couple of hundred basis points on that concept, as they start realizing that error, let's say in the next 2-3 years, what implications that would have for the actual Fed funds rate, and what the probability is that the Fed may once again find itself being seriously behind the curve. These are the risks that are on the table right now that should worry us.
So just a matter of point and fact that when you walk into the Federal Reserve building, the Eccles building, and you go through the main entrance, and you look up at the first chandelier that's above you, which is a beautiful brass chandelier from the 1920s, 1930s. I can't remember when the building was built. 30s. There's a glass etching around the chandelier, which has the signs of the zodiac in it. So at the main entrance with the most prestigious building, as you're looking up to the staircase that takes you to the boardroom, there is the signs of the zodiac. So I think the stars have been there for a long time, Athanasios. They might not be going away.
The temptation has always been there. And the whole idea of good central banking is not to be tempted by astrology.
I think it's emblazoned in the chandelier. It's there. I want to move on because we have a lot of things to discuss, and I want to turn now to Cliff and talk about one other thing. And I know there's a number of other people up here that have some strong views on this, and we'll get them to weigh in. Probably the most interesting discussion over the last year and a half has been this concept of financial stability, and financial stability playing a role in the setting of monetary policy. Governor Jeremy Stein has written a lot about it. He's probably been the most prolific, although Dan Tarullo has also spent some time on it as well. You've seen quite a debate back and forth, and I think the debate centers around a pretty simple concept that maybe we should be looking at a broader array of financial conditions when we think about the setting of monetary policy, and that's probably not a very controversial statement, but when it comes to thinking about trading off inflation, unemployment, and financial market stability as a third concept, I think that's where we get a lot of people with a lot of heated different views. And what I wanted to do was bring Cliff into that discussion, because Cliff has had 20, 30, almost 30 years experience now, I guess, trading in the credit markets. And if there's one person that I can think of to call up and ask, do we have too much froth in the credit markets? Are we in the middle of a credit bubble? Is the Fed creating future financial market vulnerability by running interest rate policy the way it is? One of my first phone calls would be Cliff, because he's been doing it and seeing it for so long. And I think I just love to get your views up here, Cliff, on whether you see the signs of a credit bubble developing in the United States, and in a sense, is that attributable to monetary policy, or is that just the natural ebb and flow of how credit markets always operate? And to be sure, we've created credit bubbles in the past without monetary policy like this, or balance sheets like this, so certainly they can happen again, but I'd love to get your thoughts on that.
Great, David. Well, thank you. When I was asked this question a few weeks ago, we had some conference calls on this, and my initial reaction was perhaps we were in a credit bubble, mainly because of the high level of new issuance, both in the high-yield bond and loan market and in the investment-grade market. We're at record levels of issuance. If you step back and look at previous bubbles to see what they were like, I think it's important to do that over the last 15 years, and there's been several of them. We all know about the corporate credit bubble back in 07 and 08, a big mortgage bubble in 07 and 08. Then go back further to the beginning of the century, we had the telecommunications bubble in high yield, where telecom was about a third of the high yield market, and over 90% of those companies ended up defaulting. And the biggest bubble of all we all probably experienced, if you're old enough to remember it, is back in 1999 and 2000, we had a huge bubble in internet, telecommunications, and technology stocks with Intel, Cisco, and Microsoft, believe it or not, selling at 50 to 100 times earnings. We all remember what happened with that bubble. So back to today, I want to start just by mentioning from an issuer perspective, why are all these companies issuing debt in this market? This is a dream come true for CFOs and for treasurers. They can issue tax-deductible interest expense debt and get, on a 5% coupon, cost of capital of probably 3.5% to 4%. So the after-tax cost of capital on debt today has never been lower. So that's why companies are issuing it as much as they are. Some of them are using them for shareholder-friendly purposes like stock buybacks, dividend increases and the like. But it is a great environment for companies, and that's why they're doing it. So back to today again, issuance has become more aggressive in the high yield market, mainly starting the beginning of this year. There's been some big dividend deals done. BMC Software was one of them. Assurion was another one, another large deal. And these companies are well known to the high yield market, and they have the ability to tap the market like this. Not many companies do. There was a huge amount of these companies doing this back in 06 and 07 when these huge LBOs were being done, and they were tapping the market and doing dividend deals, taking a large percentage of their equity out. I don't think we'll see that happen. I think there'll be more discipline this time. But that would be what does create a credit bubble, is very aggressive issuance like that. So looking at the reasons supporting why we would be in a credit bubble today, we have record low yields for both investment grade and high yield. That should be a warning shot across the bow of having yields that low. But if you can turn to slide 27, I think most sophisticated investors will look at the spread of assets versus just the yield. And the spread is a much better indication. You can see here we're at 343 basis points, which is a bit of a shock to be back there again. But there have been other times when we've been in this environment. If you look at 1994 to 1998, then 2003 to 2007, we were in tighter spread environments then. So we're not at record low spreads, but we are at record low yields. The investment grade spread would show a very similar dynamic. The numbers are a lot lower because it's investment grade. But we're not at record low spreads yet, but we're certainly moving towards that direction. Other reasons to support we might be in a credit bubble, looking at LBO activity. There has been more LBO activity, but if you think back, there were very large LBOs done in 06 and 07. The largest in history actually technically defaulted and filed bankruptcy today, TXU, $47 billion LBO. We aren't seeing any LBOs to that magnitude being done. They're all much smaller. M&A today is increasing substantially. And we are in a perfect environment for M&A, and this is all partly as a result of monetary policy. We've had $1.2 trillion of M&A deals announced in the previous 2 weeks, and there was another $100 million announced deal on Monday. So we've seen a lot of M&A activity. And just remember, there's some positives for shareholders in M&A, but there's also some negatives to the economy. Michael talked a little bit about jobs, but the Valiant and Allergent deal, if that deal goes through, there's going to be over 10,000 layoffs of very high-paying jobs on the Allergent side. So all these deals that happen with M&A are great for shareholders, but there's a cost to that in terms of the economy, and we all know we're struggling with jobs, so just keep that in mind. There's also been an increase in covenant-light loan transactions. I think there was a chart shown on the credit panel, the first one this morning. That doesn't concern us at Babson that much. We are comfortable purchasing covenant-light loans. We'd prefer they have full maintenance covenants, but they always don't. They don't always have that, but we are comfortable with buying those. The reasons against that we're in a credit bubble today, I think, are higher than the reasons for. The main reasons would be, if you could pull up slide number 13, please, corporate profits just continue to get better and better. Why are corporate profits so strong today? We all know the wages are a big cost to companies, and they've been held in check. But also management is laser focused on maximizing profits. Boards are laser focused, and now we have the added feature of having activists all over companies. So if you're the lowest margin company in the industry, you're going to be getting a call as to why that is, and you're going to have management probably be replaced, or the company will be purchased by another company. Corporate fundamentals are stable. You can look at all sorts of components. I won't show charts on this, but times interest earned, leverage, they're all in line with reasonable levels. One thing that we're concerned about is PIK issuance. And if you could pull up slide number 24, please. This is a shot across the bow of aggressive issuance. I think everybody in the room knows that. You can see back in 2007, 2008, PIK issuance peaked at 20%. And it has been increasing, but it's way, way below. It's not even 4%. It's 3.7% last year and 2.5% running right now. So it's been way more controlled. And this is very aggressive issuance, and these are much higher probability defaults, but it is in control. So defaults are fairly low today. The quality of issuance is better than it was in 06 and 07. The use of proceeds back then was for larger LBOs. Now it's more for refinancings. If you look at the percentage, it's more double Bs being issued than triple Cs. So all those reasons would point that we're not in a credit bubble, but it's really important to watch the trends that are developing, because if the trends get very aggressive and bankers begin to issue very, very aggressive paper like they were before, we will begin to see a possible bubble develop. So in summary, aggressive issuance is something to watch. Not a bubble stage yet. Corporate fundamentals are pretty strong. The economy is stable to improving, and it usually happens with very high levels of issuance. The issuance usually overwhelms demand. We haven't seen that happen yet, and we are overdue for a correction in credit. We should have a correction of 25, 50, or 100 basis points. Haven't seen that happen for a while, but it's certainly on the agenda of things to be possibly happening this year.
Thanks, Cliff. I know, Brian, you have some pretty strong thoughts, and you've written quite a lot about the financial stability stuff as well. And I'll turn to Mike, because I know you've done that as well, but maybe you want to step in and just give some quick thoughts on how financial stability is interacting with the Fed's objectives?
Yeah, I mean, this is a very important issue right now in central banking. It's being widely discussed in central bank circles, which is how monetary policy should incorporate financial stability or react to it. I think we're early on in that discussion, though, and I see two complications there. One is identifying when we have financial market vulnerability. So charts such as the ones that Cliff showed are very important for that assessment, looking for excessive issuance, looking for risk premia that look too low and could adjust abruptly upwards. But there's other parts too about how such movements get propagated through the economy, whether certain financial market participants are over-leveraged and vulnerable and so on. So first of all, measuring financial market vulnerability itself is not that simple. And then second, the other complication is, how does this respond to monetary policy? I mean, yes, if financial market vulnerability responded in a predictable, systematic way to the short-term interest rate, then I think you can make a pretty strong case to incorporate that into your monetary policy framework and take that into consideration. But that's not the case. I think, we don't know exactly what that relationship looks like. I think as a profession, we're not very good at predicting movements in risk premia on asset prices, let alone understanding how they react to short-term interest rates. So I think, I think at this point, there's a lot of uncertainties about how to incorporate this into the framework. People like Jeremy Stein have, put this into the policy discussion, have made very important contributions, and I think that's a great discussion and one that central banks need to continue to have. But we're in a somewhat uncomfortable point right now, I think, in that it's not exactly clear how to work it in.
Does it strike you as odd that over the course of this year, we started tapering basically at the beginning of this year in December last year. We had Janet come out more hawkish than many people thought she would, at least in her first press conference. So the expectation of kind of the tightening of monetary policy kind of surprised people maybe for the first 4 months of the year. But the 30-year government bond yield has dropped 50 basis points, suggesting that term premiums actually went down dramatically in response to a tightening of Fed policy. So you brought up the correlation between the accommodative nature of policy and how risk premiums and term premiums might respond. It sort of seems to me that they've responded exactly the opposite way Jeremy would have predicted, which is that you're actually lowering risk premiums when you bring that in. Is that how you see it?
Well, I guess I would back up further and compare where we are now to where we were in the first half of last year. Right. And so as expectations of easing were pulled back and as tightening approaches, I think the term premium, the two big risk premiums that seem to me that have adjusted are the term premium on longer-term Treasury yields, which is significantly higher than it was in the first half of 2013, and the risk premium on emerging market assets. So we have seen those move higher, but it's a good example because we saw a big adjustment in risk premia in U.S. rates, but it didn't have significant financial stability consequences domestically, caused some issues internationally, which I guess maybe we'll get to. But
Mike, you want to step in on the financial stability for a couple minutes?
Yeah, sure. So I think you alluded to earlier this year, I authored a paper with 3 academics where we, I think to Cliff's point, argued that their flows into spread products exhibits a lot of herding behavior, and that often monetary policy communications can serve to coordinate where that herd goes. And that, I think, does raise an issue about communications. And I guess, Brian, I'd partly take a little bit of issue with how you describe the forecast in the SEP as, hey, the market should understand that these are just a forecast. I think in a perfect world that's true, but in a perfect world, all you'd really need is a statement of longer run goals and monetary policy strategy. I think the market, sees some of that communication and assigns too much precision to it, and I think that's a bit of a risk here in terms of the way they are communicating with the market, and that it can lead to, when you have changes in policy, changes in how that herd behaves. I guess more generally, in terms of incorporating financial stability concerns into monetary policy, I'd say the more recent vintage of research on this seems more reasonable and less perhaps Germanic than the earlier thinking, which is, if you look at the work being done by either Koch or Lakota or Woodford on this, it's not so draconian as to say, hey, when you have a really big output gap, you need to factor in financial stability concerns in a big way. But as you get closer to achieving your traditional mandates, that it makes sense from a mean variance perspective of thinking about your goals in a longer run horizon to fold in these considerations to some degree. And obviously, I'd agree with Brian's point though on the practical hurdles of doing that. I don't think that alone should invalidate it. It just means that it's going to be not a simple thing.
I was struck the other week at a conference I was at, speaking with Jeremy on a panel, that he didn't seem that concerned about the current level of rates, but did suggest that if we were back at a 160 10-year note like we were in the beginning of 2013, and the spreads were ripping tighter as they were in Q1 of 2013, as you'll probably remember well, Cliff, that's when you're sort of, the hair on the back of your neck goes up and you go, hey, I got something here I need to think about. But current levels didn't seem to play a big role, and the whole debate about financial stability was sort of more on the fringes of the objective function than something that was central to the dual mandate. It was really a sideshow to the two big issues, which are unemployment and inflation. I want to move now to a little bit more of an international flair. We've got about 20 minutes left, and we're lucky enough to have Athanasios here, who spent 5 years sitting in ECB meetings during some very interesting times for the European Union. And I wanted to ask you, and then open it up to the panel as well. We've got the Fed and the Bank of England sort of going through a process of trying to tell us that they're pulling accommodation away slowly. We have two other major central banks, the ECB and the Bank of Japan, which are still somewhat focused on remaining accommodative or potentially even adding accommodation, although I guess Mario Draghi spent some time in front of German lawmakers in the last 24 hours telling them that it wasn't imminent. But certainly we hear every time the euro pops up to 139, 140, it is, and then every time it's back a few big figures lower, it seems to be off the table. Athanasios, could you give us a kind of an overall view of where you think this juxtaposition is in sort of major market central bank policies? Two big ones going one way, two big ones going the other way. Are we ready for some very big foreign exchange or very big interest rate differential moves because of that monetary policy move? And how do you think about the overall global nature of monetary policy as you have these central banks, for the first time since the crisis, actually moving in opposite directions?
This is the key issue for the first time since the crisis. Let's see slide 1. It shows the balance sheet of the central banks that you mentioned. I think it's quite informative to help us understand a little bit the disconnect, in particular between the Fed and the ECB, the top two regions there. So when we had a global crisis in 08-09, we had a synchronized recession in all of these economies, and monetary policy moved in the expected manner, very forcefully and similarly in all of these economies. What we see now is a reflection of the fact that things did not turn out after that initial response to be similar in the different regions. So if you look at the US, you had, after the original episode, QE2, then you had the last year and a half QE3. I am amazed that you guys are talking about the Fed tightening, whereas the Fed continues to be easing massively policy. So what you are referring to
Removing
is,
accommodations.
what you are referring to is that the Fed is no longer promising that they are going to expand the balance sheet to infinity, which is a good thing. But it's not as if they've changed the directions and are tightening. They're just about to stop accommodating monetary policy even further. So let me just focus on the ECB. The euro area has gone through a tragic depression in the last 3 years as a result of the mishandling of the crisis. Part of the mix that has made it extremely difficult for the ECB is that this is a political crisis that the central bank cannot correct. The ECB has been caught in the middle, and the ECB, unfortunately, ended up being caught up in the politics of the situation and pursued monetary policy that, in retrospect, has been incredibly tight. So when we hear the discussion right now about what the ECB should do next, the rest of this year and next year, we need to keep in mind that because the ECB has been incredibly tight, the size of the balance sheet of the ECB has shrunk considerably in the last year and a half. They actually have contributed to very low inflation rates. Inflation is significantly below the ECB's primary mandate. Since the ECB is not meeting its primary mandate, they have to pursue a highly more accommodative monetary policy. So they are in the position right now of having to pursue this highly accommodative monetary policy. And I hope that they do it sooner rather than later. The more they delay this, the more costly it is for the euro area. But they have to do this because they've been too tight over the past 2 years. And this is what is creating the disconnect with the Federal Reserve. Federal Reserve has expanded, I would argue, more than it had to with QE3. So now they actually have to start unwinding some of that expansion. The ECB should have expanded alongside with the Fed over the past couple of years. They didn't do this. And right now they are in what the IMF calls a lowflation environment. It's an extremely toxic environment when nominal income is not growing, not in the euro area as a whole. I want you to focus a little bit on the periphery of Europe. It brings into question the sustainability of debt for some of the larger periphery economies. And this is not pretty. The fundamentals of the euro area are not as great as they would have been if the ECB had followed the Fed into the expansion. It's great news for the euro area that markets are so incredibly complacent about the crisis in Europe. And as long as that continues, monetary policy mistakes are less costly than they would otherwise would have been, but the risks are there. It's actually shocking to hear what you just mentioned, Dave, that the president of the ECB in meetings with German members of parliament would have talked about whether the ECB would do QE or not. This is really shocking.
Why?
Well, it's in the treaty in the European Union. This is the independence of the ECB is much better protected legally than the independence of the Federal Reserve.
With lawmakers quite frequently.
Yeah. I know, but you have to be very careful in the context of the euro area that monetary policy that is formulated by the ECB should be formulated to be the best policy for the euro area as a whole. It's shocking to give the perception that monetary policy is designed to be more in line with what would be appropriate with any single economy in the euro area, and unavoidably it may actually lead to such thoughts.
While we don't have enough time to talk about this one, I would say that the the TALF, the TAF, the PDCF, the AMLF, every FF that we created at the Federal Reserve was in conjunction with certain parts of the economy, but maybe not other parts of the economy. It went to bail out a lot of institutions, but didn't really get a lot of focus across a lot of other parts.
And Dave, I need to actually make sure we understand the differences between the U.S. and the euro area in this. If you had told me that the Federal Reserve was coordinating with, say, the state of Texas to design policy to optimize economic performance in Texas at the cost of the rest of the country, then I would have told you, oh yeah, this is similar to what may be happening in.
But it happened in sectors, not in states, is what I would say. But nevertheless, I want to take you back to Japan really quickly, and then open it up to everybody in the last 10 minutes, because you didn't spend any time there. One of the themes that I've written about a lot, and you and I have discussed a lot, is this idea that the ECB is acting much like the old Bank of Japan. And if we think about Japan from the time of its crisis in 1990 until Abenomics started, the features of the Japanese economy were a very strong currency, a very strong bond market, a very weak equity market, and very high short-term real rates. We're seeing low inflation and high real rates in a large part of Europe, in particular the periphery. We're seeing a very strong currency. We're seeing a very strong bond market. We've had one of the most incredible runs recently in even the peripheral bond markets, but certainly the core. This ECB looks a lot like the old Bank of Japan, and many of the mistakes that I know you've written about and many of the folks at the Fed have written about in Japanese monetary policy, that it looks like they're finally rectifying. Why is the ECB making such an obvious mistake?
It's very uncomfortable to even be able to make these links. And you're absolutely right that the monetary policy of the ECB over the last couple of years has been unnecessarily tighter than it should have been, in a fashion that is very similar to the overly tight BOJ policy that lasted until just a couple of years ago for a very long time. And we have seen what the consequences of overly tight monetary policy have been on Japan. It would be scary to project the consequences of that in Europe for the ECB. The considerations, however, are quite different. What we have in the euro area, as I mentioned before, is a political crisis. The ECB is caught in the middle of this, so they have to legally do the best they can in terms of the setting of monetary policy for the euro area as a whole, subject to the constraints that they're facing within governments in the euro area, essentially fighting it out about what the future of the euro area is going to be. So what could they do? One of the most obvious things that the ECB could have been doing, and this is what has been in discussion now, is quantitative easing, much like the Fed, BOJ, the Bank of England. Why aren't they doing it? Well, because you do not have a euro area bond market in Europe, so it's not as simple as it sounds. It actually does have a political element to undertake quantitative easing in the context of the euro area. In my view, there are no legal issues, and it could be done. So the ECB could start tomorrow purchasing euro area government bonds by capital key, proportionally essentially to the size of each euro area economy. But to understand what this is relative to the United States, that would have been like having the Fed starting to purchase California and Texas and Massachusetts bonds rather than U.S. treasuries when it decided to do quantitative easing. The additional complexity that they have to buy member state assets is what has been holding them back. It's unfortunate. It has led to a mistake of overly tight monetary policy, but we need to realize the reasons why the ECB ended up being tighter than it should have been are not similar to the BOJ mistake. The BOJ never had to face the political dynamics that the ECB has to face right now.
Brian, you want to give some thoughts on the international side and sort of this idea that you have different central banks going in different directions at the global level for the first time since the crisis?
Sure. I mean, I think the short answer is yes, these central banks are going in different directions. Bank of England and the Federal Reserve are heading towards the removal of accommodation, even though, yes, the Fed is still easing today, but I think we're all looking ahead to when rates start to rise. Bank of Japan is easing. ECB should be easing, and I think will be easing before too long. So I would expect interest rate differentials to increase. I would expect that to be reflected in exchange rate movements. And just a broader point, these unconventional policies, obviously the Fed and others, we believe they work through portfolio balance effects. It's actually the size of the balance sheet that matters. But they also work through expectations. And I think we've seen that most clearly in Japan. So that I would say the BOJ certainly did the right thing in being so aggressive and really communicating a regime shift that shifted expectations and helps them meet their mandate. I think you saw this at times in the US very clearly, especially right at the beginning of QE2 when inflation expectations really were falling quite rapidly. The willingness of the Fed to use the balance sheet as a proactive policy tool, I think really changed the psychology and affected expectations. And I think for the ECB, unfortunately, you have that channel kind of going in the other direction, that just for general policy accommodation, they've seemed more reluctant to do that and therefore aren't getting the benefits of those expectations channel. I mean, they certainly got it in terms of defending the euro and shaving off a tail risk, and the we'll do whatever it takes approach to the periphery certainly was important and had this expectational channel, but they haven't gotten it working, I would say, in a broader sense to support growth.
So we have about 3 or 4 minutes left, and I thought Athanasios brought up astrology and the stars. I'll ask everybody to put their palm reading hat on here in the end, and in 30 to 40 seconds, put yourself in the position of a Federal Reserve governor and make a forecast for the end of 2016. The current SEP, I think, averages out at about 2 3/4 for growth, a little under 5.5% for unemployment, and about 1.8 for headline PCE inflation. If you could give us those 3 numbers to your best abilities, and then also make a small projection about whether the funds rate of 2% at the end of 2016 is also a reasonable estimate in that scenario, as well as the scenario you provide. I'm going to start over here with Mike.
Maybe I haven't been out of the Federal Reserve long enough because my forecast is pretty similar to that. I would see a little later liftoff than they have, but perhaps a little faster pace of tightening once they begin the liftoff than they have. I also think while it's very fraught with uncertainty, that neutral funds rate probably has come down some, so perhaps the terminal point would be a little bit lower. But to me, and at least in broad contours, I think their macro forecast looks pretty reasonable.
Cliff?
I don't have any official forecast, Dave, but I'll tell you that I hope a year from now we're at this conference, or 3 years from now, or 5 years from now, we have other things to talk about. We've been having 0% rates now since December 2008. We've had a series of QE, and our economy is still not growing naturally on its own, and we need our economy to get jump-started here and start to finally function without all these interest rate policies to help it grow.
Athanasios?
Well, point forecast can be incredibly misleading, so I'm not going to give you point forecast. But I will say this: I'm an optimist on the U.S. economy. I think that despite the complaints that it's not growing as fast as some would have wished, or the unemployment rate is not coming down as fast as some would have wished, I think we are on a very solid recovery. In this scenario, I would expect a much faster clip on the Fed funds rate than what the dots have right now.
Brian, you going to take a stab at this and not deflect like everyone else?
No, I think I'm pretty much in the same camp as Mike, so it seems like we're all in agreement. I mean, I am optimistic about the U.S. outlook here. I think we're kind of moving into the second quarter in a nice way. My forecast for end of 2016 would be pretty similar. We're close to full employment. Inflation has drifted up towards 2%, maybe not all the way to 2%. And the Fed funds rate is certainly more likely to be above what the FOMC is forecasting than below. So I'd say 2.5 at least.
So in the spirit of the McLaughlin group, where there's always a right answer at the end, according to John McLaughlin, I'm going to put numbers out there for you, and under the presumption that I've operated with for a while, not just with Ben, but certainly with Janet, which is that we have a James Tobin trained student who spent many years at Berkeley, so the amount of salt water inside of the Federal Reserve System is very high, and I expect a very dovish Fed for a very long time. I would say growth is going to surprise on the upside, so I'm going to be at 3 on growth. I would be at 1.5 on inflation, 5.5 on unemployment, or maybe a little lower toward 5.25, and the funds rate significantly below 2, more toward 1. That's the John McLaughlin answer. Thanks for attending the Monetary Policy Panel, and enjoy the rest of your time at the Milken.